Hi, welcome everyone to another episode of Let's Talk Special Economic Zones. I'm your host, Ainsley Brown. And in today's episode, we're going to talk about the OECD's inclusive framework, or it's designed to counter um, what's called base erosion and profit shifting. So we'll go into exactly what that means and why is it significant for special economic zones. Now, I always do this in all episodes, so let me just get it out of the way. So the name special economic zone, you can also have free zones, enterprise zones, foreign trade zones, etc. It's all the same thing, right? How it works exactly in a country is going to vary per its legislation, but it's in essence the same thing. It's an area, designated area where certain special incentives, sometimes different laws are modified that operate within the rest of the country are different, and people are incentivized to come in and invest, um, and do their commercial operations. So the OECD's inclusive framework has many components. There are multiple components to it. We're going to focus on three. And the first one is about, in essence, that there should be substance requirements within these preferential regimes, so to speak, which what special economic zones are, because they grant special privileges, special fiscal incentives, and that's the part that the OECD is concerned with. It's not concerned with other elements. It's concerned with the fiscal, the tax part. So fiscal incentives are the government foregoing collecting taxes. So its corporate income tax rate might be 25, 30%. However, in a special economic zone, they say, okay, I'll give it to you for 15, 10, or 5 or 0, right? So they're concerned about that. So in terms of the preferential, so we have established that special economic zones are preferential regimes. So immediately the OECD has a concern, or it falls within the ambit of the inclusive framework. And what they're trying to erode or erase, I should say, or mitigate against is what they call BEPS, or base erosion and profit shifting. And in essence, it is whereby you're using tax havens and you're shifting money around. You have a situation where, in country A, a company, is developed, evolves, and grows. It then expands to country B, and country C, as typical globalization and those sorts of things, multinationals, emerge. But then what it tries to do is, of course, it wants to lower its tax burden everywhere. So country A charges, say, 25% corporate income tax rate, but country B and C are, have special economic zone regimes and say, okay, I'll lower mine to 10%. So B and C are doing 10%. Of course, you know, the company is going to say, great, I'm going to relocate some of my operations, if not all my operations there. Well, let's say they don't relocate everything, they just locate some of it to those lower tax jurisdictions. And there's nothing wrong with that. Countries benefit from that in terms of attracting foreign direct investment and having jobs and development and growth and all of that. That's positive. What the OECD doesn't want is, per se, is then that, let's say it's a manufacturer, or even it's a services company, could be an internet giant or something like that, or e-commerce company. You then set up, say, a warehouse in country C. Okay, great. You're distributed from there, service in a region. Then, or I should say country B, let's keep it simple, country B. And then country C, what you do is all the intellectual property, let's say, um, from from both A and B, is sent to country C and is registered there. So country C, that the company that's there, it's a separate company, but it owns all the intellectual property. And then A and B have to pay them fees to license the use of that. In country A and country B, well, country A specifically, let's deal with it, just keep it simple. Country A, that's an expense that lowers your tax burden. So that lowers the amount of money you technically have to be taxed. So that then lowers the amount of tax that country A would be collecting, right? And it doesn't have to be intellectual property. It can be from management. So they shift certain processes over to country A, B, and C, and or even just the C. It doesn't matter. And they then create an expense which then lowers. So that's what's called, profit. It's profit shifted in essence, and then it erodes the tax base erosion and profit shifted BEPS of country A. So that's kind of what they're trying in a nutshell. It's more complex than that, but that's what they're trying to cut out in a nutshell, mitigate against in a nutshell. But worse than that, so something like that, that's sounds typical of how foreign direct investment works. What they don't want then is then in country C, which has all that intellectual property, there's no real activity happening, right? It's not justified. It's basically just a company that's incorporated in name. It basically has no employees, but the money is going there, right? Um, so that's part of what. So the substance now is you must have employees, you must have done investments, those things. So that will actually be to the benefit of country B and C, especially C in our example. So that's one area. Another area, and attached to that substance is, and specifically to the IP, what they also don't want is what they call IP regimes, where that specific example I used is happening, so that that you're not running a regime where all you're doing is just collecting. So the IP really wasn't, there was no research and development happening in C, no improvements. It's just a place that money is collected because it's not taxed at 25% in A, but 10%, and perhaps even lower because you might have added certain other deductions, credits that can then further, in a sense, lower that tax. So that's one. Two is another area where it's global corporate minimum income tax. This has slowed somewhat. It very ramped up in 2021 and early parts of 2022. It slowed somewhat. However, the UNCTAD investment report warns that even if only a handful of countries do it, there's still going to be significance because this report, UNCTAD Investment Report 2022, speaks to, and is very data rich, speaks to um, that the fact that most foreign direct investment comes from about 5 countries, a handful of countries. So if those countries implement this global corporate minimum income tax rule, which is supposed to be set at 15%, then in essence you have a global deal because that's where most corporate or FDI comes from. Now, this arrangement says that you shouldn't really be below 15% in terms of the preference that you're granting or the fiscal incentive that you're granting to companies. However, it doesn't say that you must do it. What it says is, go ahead, you can have a lower rate. So if you say you have a 10%, what it does, it allows, so country A and let's go country A and B, the home country, country A has 25%, country B has 10%. So it says there should be a minimum of 15%. Now, it doesn't say you must do it, but it says it allows country A, the home country from which the foreign direct investment emerged, to top up, right? To top up. So top up to 15. So basically, you would have paid your 10% in country B, but then country A can then top up for the remaining 5%. There's a little caveat to it. There's several caveats. There's some industries that are exempt. Mining, for example, and shipping are exempt. Also, there is a threshold in terms of companies that it would apply to. I can't remember the exact figure. It's quoted in euros, and that is basically, the profits that they make globally. If anybody's above that threshold, then the that 15 global minimum would kick in, right? So that's something to watch, and will modify it potentially could modify how the fiscal incentives that zones put together as part of the fiscal package to attract investors. Also, it's going to potentially modify who you attract depending on what you do. And in another episode, I'll get into that because there's some very strong nuance here that you know uh, that I need to get into. The third area, and that's what they call Pillar One. Pillar Two is where this is to address kind of e-commerce, to address electronic transactions going across borders. Again, they've put in a threshold where, companies that basically earn above this, those are the ones that and there's a very complex formula there that they've put in that says, if you earn above this and whatnot, then yeah, the home country gets to collect that money. And there's supposed to be some mechanism where the host country B and C, would get some of that money. I think they're still working out some of that detail, but those are very, very important. Um, so the last two, that is the global minimum and the e-commerce or electronic transactions, are still being refined, still being worked out. But the first one is definitely here, and many countries have actually already acted and modified their legislation to drive things forward. Now, if you like this episode, please like, share, subscribe. If you want to see me do a particular episode or a particular topic, please like or please leave a comment down below and I'll get right back to you.